Okay, let's talk about a huge question in climate action. We keep hearing that we need more money, trillions more. But what if that's not the real problem? What if we have enough capital, but the system that's supposed to direct it is fundamentally broken? Today, we're going deep on why the climate finance gap is really a system design failure. So, get this. In 2024, the numbers came out and global climate finance officially crossed the $2 trillion mark for the year. And on the surface, that sounds incredible, right? It feels like a massive win, like the world is finally putting its money where its mouth is. But is it really a milestone? Or is that headline number actually a misdiagnosis of the problem? We're going to make the case today that focusing on that big number is distracting us from the real issue. The financial architecture itself is flawed. So here's how we're going to break it down. We'll start with that $2 trillion headline, then we'll expose 5 critical fault lines in the system. We'll look at the huge gap between how investors perceive risk and what the reality is. We'll see exactly why projects that protect people are getting left behind, and then we'll get into the solutions, 7 big levers for change. And finally, we'll ask the toughest question of all. Who's actually in charge here? All right, first things first, that $2 trillion figure. There's a perfect way to describe this. Scale is a weak proxy for adequacy. Just because the total amount of money is getting bigger doesn't mean it's actually doing the right job or going to the right places. And this chart just lays it out so clearly. See that bar on the left? That's our $2 trillion in current flows. But the bar next to it? That's what the International Energy Agency says we actually need every single year by 2030 to hit our net zero targets. We're talking more than double what we're spending now. So the gap isn't just a shortfall, it's a massive structural chasm. So, if the money isn't the only problem, where is the system actually breaking down? Well, this gets us to the absolute core of the issue. We're about to deconstruct the whole thing and look at 5 hidden fault lines that are warping the entire financial system. Okay, here are the 5 big distortions. First up, there's a huge sectoral skew. Think of it this way. Money loves projects that make money, like solar farms, so mitigation gets funded. But adaptation projects, things that build resilience, like seawalls, they don't have a clear cash flow, so they get left in the dust. Second, geographic concentration. Capital is a creature of habit. It stays in developed countries and a few big emerging markets, while the places that are most vulnerable to climate change get ignored. Third, there's an instrument bias. We have tools like green bonds, but they're built for those big, shiny, revenue-generating projects, which means they're a terrible fit for adaptation. Fourth, measurement inconsistency. This one's a mess. Everyone's counting the money differently, which means we might be seriously overstating how much progress we're making. And finally, number 5, outcome opacity. We are obsessed with tracking the inputs, how many dollars are going in, but we're totally failing to measure the actual outcomes. Are we really reducing emissions? Are communities safer? We often don't know. And when you add up all those fault lines, they point to a much, much deeper problem. This brings us to the gap between perception and reality, and the real reason all that capital isn't flowing where it's needed most. So, the story you always hear is that emerging markets are just too risky for big investors. That's the perception on the left, worries about currency, politics, you name it. But here's the kicker. The reality, and this is backed up by data from the OECD and the IMF, is that the actual default rates on infrastructure projects in these places are consistently lower than what investors think they are. Now, this huge gap between perceived risk and actual risk, that's not just a bad guess. It's a classic market failure. It's caused by something called information asymmetry, which is just a fancy way of saying there isn't enough good standardized data out there. So investors are flying blind, they misprice the risk, and they end up avoiding the very regions where their money could have the most impact. And probably the most dangerous result of this whole broken system is the fact that adaptation projects are chronically, massively underfunded. This creates what's called a protection gap, and it leaves the world's most vulnerable people dangerously exposed. I mean, just look at this chart. The picture couldn't be clearer. That tall bar, that's the money flowing to mitigation, projects that cut emissions and, crucially, make a profit. And that tiny little bar next to it, that's for adaptation, projects that build resilience and protect communities. The imbalance isn't just big, it's baked into the system. And the size of this funding gap is it's staggering. The UN estimates that developing countries alone need somewhere between $187 and $359 billion more each year for adaptation than they're getting. That isn't just a number. That's the protection gap quantified. That translates directly into real-world vulnerability, to climate shocks, to food shortages, to failing infrastructure.
Okay, so we've really picked apart the problem. It's bleak, but what's the solution? Well, let's shift gears from diagnosis to action. There are 7 key institutional levers we can pull to move us from these tiny incremental steps to real system-wide transformation.
And we're not talking about small tweaks here. This is a full-on redesign. 1, we have to scale up blended finance, using public money to make private investments feel safer. 2, we need to build up project capacity on the ground so countries can create deals that attract investors. 3, integrate climate risk into every single financial model. 4, align executive pay with long-term climate goals, not just next quarter's profits. Number 5 is a big one. We have to eliminate fossil fuel subsidies that are actively working against us. 6, we need to standardize reporting so we're all playing by the same rules. And finally, 7, we need a coordinated global finance architecture to get this all working together at the speed and scale the crisis demands.
Now, pulling all 7 of those levers is obviously a monumental task. And that brings us to our final and maybe the most difficult question of all. Who is actually in a position to control these levers of change? Who is accountable? And here is the really uncomfortable truth. The very institutions that have the power to fix the system are, as they're set up right now, part of the problem. We're talking about the big development finance institutions, their main shareholders, which are basically national governments, central banks, and the regulators who are supposed to keep the system stable. These groups aren't just watching from the sidelines. They are active players shaping the rules of the game. And that really brings us to the single most important takeaway from all of this. It's a powerful idea. The core challenge is not financial accumulation, but financial reconfiguration. The problem isn't a lack of money in the world, it's a failure of system design. And the real question is whether the institutions holding all the power have the courage and the political will to actually reconfigure it.